Right. Yeah. When I so yeah, when I first started, I got into some biotech options and Bitcoin. That's how I started back in, and I rode those waves, made 10x, and took a small account, made it into a big account, and that's when I started doing more like wealth preservation, strategies, getting into SPY, selling premium against that. Um, Theoretically, with a smaller account, you could still do that with a name like AMD or something like that. You could get 100 shares, and AMD premium is actually pretty good. Um, you should be able to generate, good premiums with that, and maybe you can, speculate with the income on that. That's not a bad idea. That would be one strategy I consider if I were to start over, all over again. Yeah. Well, let me just check AMD right now. Let's actually check it together. Can you guys see my screen? Yeah, you good. You see it. Okay. Uh, AMD. So if somebody were to start over, buy 100 shares and start wheeling this thing, I mean, well, with the way the market's going right now, I'd start selling puts. But yeah, one put, uh, July 15s. Um, yeah, you can commit to buying it at 70. I mean, if you were willing to spend 7,000 on your $10,000 portfolio on this and generate what, 2%? So that's 2% for the 15th. I mean, if the market goes up, you could, take quick profits on that and re-enter if the market comes back down. So that's one way you at first, when you start, you would probably be just trading back and forth this premium, this put premium. Okay, so if you had 10 grand, and I don't know what's gonna happen to this, um, it went up 10 cents today. Let's see here. Um, let's see how much it is. Let's see the price history of that. So yeah, I mean it's at $1.27 now. It was all up at $1.40 at its lows. Let's see what it was at its lows. Yeah, I mean it was all the way down to 38 cents just 3 days ago. So I don't know if tomorrow it rallies and this thing is in the single digits, then yeah, or double digits, then take profits. If it goes down to the 40s or 50s, you just made $80 on $10,000, which is 0.8% in a day. So you would be actively doing this. Okay, so if you're trying to do that 2% compounding weekly idea that I shared with you guys a couple days ago, that would be a start. Somebody asked, what would you want to do if you were just starting out with like 10 grand or less? How would you like start a wheel process? You could start it with something like an AMD, Apple. Well, Apple you would need a little bit more, but AMD is a very good prospect for that. It's got pretty good. Okay. I mean, long term, right? Yeah, yeah. So AMD. So yeah, again, like let's get back to this before. Hold on. So before I forget, this right here, even if this were to go down, so in your example, like you had Apple, right? I don't know if you had 100 shares, but if you had 100 shares and you were trying to sell puts on this, you don't. And let's say you bought, it was 175 at the time. If you were to sell puts at that moment when you bought, you probably would have gone a little bit out the money, just like on AMD we'd probably be going a little bit out the money. That doesn't mean you hold on to this put position. You can also roll it for additional credit if the delta start going up. It's at delta 21. So if it gets to like delta 35 or so, roll it out till for, I don't know, maybe another month or maybe extra couple of weeks. You may be even able to roll it down a little bit. So you may be able to roll it down to like 65 or so and still collect a little bit of a profit. Okay. So, well, for what? For AMD? Nice. Okay. Hey, before the market closes, because we only got 25 minutes left, let me go over what I wanted to go over before the market closes. Okay, we might be making some trades here, if certain conditions hold. Okay, so save your questions for a little bit later. All right, so right now, in our long China, or I'm sorry, long puts on China, we are seeing this Australian dollar rallying quite strongly at the end of the day here. Okay, this is not what I wanted to see. All right, especially the weekend before a huge data dump in China. So they're about to dump a lot of economic data this weekend, and they're choosing to do it on July 4th weekend. Probably not a coincidence. The U.S. is a source of one of the largest sources of capital flow in the world. So it's a lot easier to move markets during this time, especially in currencies, foreign markets, and also in commodities, to a certain degree commodities, but especially in currencies. So are they trying to do something with this? Maybe. But yeah, this is not what I wanted to see. Even though I did say I didn't want to touch it, if it doesn't pass these points, tomorrow, I mean, I'm still going to hold my FXI puts, but tomorrow, if this rallies hard tomorrow, I may reconsider holding on to this. I may reconsider just the FXI, because if there is a data dump and Sunday, Monday, this just blasts right through, I'm not going to have a chance to get out. Although it is a very small position, I might just get out of those Augusts that I have. I think they're down about half. So I might just save those for, I don't know, just for later on, after, if it pumps, and after it pumps, I can buy more spreads. It's not a lot, but still, it's probably not something I want to hold, something that's unhedged. Okay, so that's Australian dollar. It's gonna close. Of course, it's gonna close right there, and make it all confusing. Let's look at some monthly charts here. Okay, so what I like to do at the end of the month is take a look at the long-term trends, and I also like to review what has worked and what has not worked. Okay. I think that's important to look at. Most people don't review what they've done and what they haven't done. All right. If you recall, in the beginning of the month, we were still in that bear market rally that started in the end of May. Yes, right here. Yeah, right there. We just got off the bear market rally, and we were still here. At that time, our plan was to buy puts around here. Around here, and then and wait for this rally to go through. It never happened, of course. June 9th with the ECB meeting, everything sold off. at that point, I was saying, we were doing small little day trades, little lottos here and there. We did play UVXY. That was a big winner for us. UVXY puts last month. That's where most of my gains came from last month. I gave some of it back playing some stupid lottos, but I was able to walk away with a small profit. And I think considering the conditions, I talked to some of my old colleagues that are traders, institutional traders, and still working at major financial companies. A lot of them were either on the wrong side of a trade, or did something that the markets did something that they didn't expect, and a lot of them have losses for this month. So considering that, I think a small gain is something worth celebrating. So sometimes it's not about what you make that is a success. Sometimes it's what you don't lose. All right. It's important to keep capital. All right. So we were able to keep everything small. We kept everything really small, and we stood and waited most of the time. And you know what? That has been our reward. Less losses than even the pros. So that's I consider that a win. All right. Next month, let's look at what's going to happen. Okay, or let's try to see what we can plan for. All right. So it looks these are all big drawdowns. Let's see if the bond charts have been updated. Yes. So this is the monthly. As long as nothing too crazy happens for the next 20 minutes, this should be what our chart looks like for TIP over TLT. It still looks like it's in an uptrend. What 20 minutes? What do you mean? Somebody said end of month rebalancing. Right. And that's normal with rebalancing. That is quite normal to see. I don't suspect TIP, TLT to move that much by end of day, just because it is hard to move that. We're talking about bonds here. We're not talking about stocks. Stocks, yeah, they can move easily, small stocks. But who knows? Maybe you're right. Maybe it does move a little bit here. But this close definitely for today signifies that, yes, inflation expectation. And we kind of saw this coming, right? We saw this coming earlier with crude coming down. We called the top in crude, right? So it shouldn't be a surprise to us that the bond market is flashing that we've peaked out in inflation. Okay, is it possible that it comes back? I do think so. I think inflation will come back, but it can peak for the season for the next 3 to 6 months at least. Let's look at the monthlies for oil. Oil, same plan. Man, that would have been nice if we got that short here. Oh well, shoulda, coulda, woulda. I mean, there was no safe way of doing it then, because it just sold off immediately. It didn't really retest. Yeah, it sold off immediately. Hasn't retested. I mean, if you consider this a retest, I don't think so. I think it has a chance of getting up here. Okay, 120. So again, that's the plan. Some of you are probably going to play what, Exxon? Is that what you guys are probably going to short if you short oil? Or are you guys looking at like XOM? Did NRGD? Oh. Yeah. That I don't. Okay, so yeah, Okay, so if you're gonna trade this, I mean, so you're just day trading this? Is that what it is? Right. Right. Yeah. Okay. I mean, NRGD is one way of playing it. I guess if you don't know options, yeah, that's if you want some leverage, that's one way of playing it. I would stay away from this. It looks toxic. I know one of you mentioned XOM as like your vehicle of choice to short for shorting oil. I mean, it's not bad. XOM options, XOM puts are not bad. It's a pretty good market, you know. Um, I mean, we'll see what these how much these are worth when it goes up, if it goes up, even if it goes up. Yeah. That's true. Or you can use, I mean, you can always use also XLE, the ETF, so that you're not taking like company specific risk. You know, um, I think it's actually a little bit cheaper too. It's a little bit cheaper because it's an index, so the implied volatilities are less. But I mean, I will say like if it moves, I mean XOM from what 105 to right now it's 85. XLE 93 to 71. 93 to 71. So it's about the same percentage. I guess it's about the same percentage. Um, yeah. Okay. So that's one option. Yeah, XOM's good. XLE is good. Um, I am leaning toward just straight up using futures contracts options. Um, Well, okay, so yeah, but that's a little bit different. Like when you own the shares and you're like dollar cost averaging, I mean, yeah, for long term holds. I mean, Exxon, yeah, as a long term hold as part of a portfolio, yeah, that definitely makes sense. And you're probably collecting a nice dividend from it too. It's a very nice dividend payer. Um, what we're talking about is just short term trades here, like swing trades, weekly, monthly moves. Um, yeah, yeah, I think so. 120. That's the key. Right. So yeah, definitely. I think this is the option. I'm gonna just go with this one. Actually, that's actually a good point. And yet, like, there's a lot of options, and I'm not gonna knock off an ETF because if you look at the skew, okay, coming back to these concepts here. These concepts are important. The skew actually is a little bit steeper, I think, on the month that I want on USO. Hold on. I mean, also skew will change. You know, USO is the no, it's not leverage 3x. It's just the huh? Say that again? No, it's a futures rolling ETF, but it's not leveraged. So it's just it owns the front month futures contract and rolls into the next one, but on an unleveraged basis. This is the most liquid and most often traded oil ETF in the market. I'll take a look at that at the very end. Okay, we'll take a look at Bitcoin. Bitcoin market trades 24 hours, so we can do that towards the end. Um, yeah. Um, Very possible. I myself, I'm going to dollar cost average into Bitcoin starting at 14, but my biggest buy will probably be under 10. But I'm going to start legging in at 14. That's just me. That's just my plan. Um, I think the risk to reward starts getting favorable for longs at around 14. Um, but yeah. And that's why they lose. If you base everything off the charts, that's why 99% of retail loses. So why emulate the 99% that fail? I don't understand that mentality. Um, I mean, yeah, I mean you can still use charts, and I know some people who use charts and still win. But usually the reason why they win is because of risk management. It's their risk management technique. The charts is just a trigger. It's just to see what the previous price action is. So I mean I understand that, but you know yeah. Yeah. So no strategy is going to be 100%. Okay. Even my process, yeah, it's not 100%. Charts are not going to be 100%. And that's why I always keep focus. I always ask you guys, to always exercise risk management. No, no, no. I don't take it that way. No, yeah, we got 5 minutes left. Okay, give me 5 minutes. Okay, yeah. Can you chill for 5 minutes? Yeah, yeah, yeah. 5 minutes. 5 minutes, Nanya. I promise. Yeah, 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 yeah. Yeah, yeah, we can tell. That's okay. We got 5 minutes left until the market closes. Let me do this 5 minutes. Yes, I agree. Yeah, charts. I mean, it's not that I don't use it. I just think most people use it wrong. All right. death crosses, golden crosses, all the when one moving average goes above the other. That to me is nonsense. But yeah, I mean the way the candle looks for like especially weeklies or monthlies, longer term trends, what the high lows are. Yeah, that's very important. I look at that stuff too. It's not like I have a line chart. All my charts are candlesticks. I do use that, but it's just after some point, it then becomes more about the data. At least in my strategy, my strategy is all about the reward to risk odds. And that's the way I win. I win by using reward to risk odds and what the options market tells me. Everybody's got whatever trigger that they want to do. As long as it works, hey, it works. I'm not going to tell someone to stop charting if it's working for them. If it use whatever works until it stops working. That's the life of a trader. Anyway, but let's get to the stuff that we can manage right now. So right now, Australian dollar is still doing its thing here. Let's see. Okay. Well, it's not that big of a gain. It looks like FXI is coming back up. We'll see what happens. We will see what happens with that. I still think there's still more pain ahead. EEM is still down, so that's good. So that's favorable. Our gold trade has come down a little bit. And everything else looks about the same. Oh, we got a slight gain in UVXY spreads. I was going to add some more if we had a down day in UVXY, up day in equities, but that doesn't look like it's happening. Okay, so never mind. I don't think I'm going to be doing anything. I thought about maybe getting out of some of the FXI, like some of the August contracts, but I don't think I'm going to do that. I think I'm just going to stay put. It's such a small position. Let's just write it out. Let's just keep our original plan. Our original plan was holding on long until this breaks. So it hasn't broken. I'm just a little bit worried about the size of the up move today. That's it. We are 2 minutes away from closing. Probably nothing big is going to happen. Let's look at the monthly charts. So every month I like to do this at the end of the month. I like to see what the monthly chart is telling us, the big picture, because that's where we make most of our money. Most of our money is made with the big picture, right? So just like, like this, let's go to the weekly for equities. Why is this? Oh, that's ES stock. That's what I wanted. Okay. So yeah, I mean, long-term trend is down. All right. We were in a bear market rally. And now it looks like we're continuing down. Okay. And again, our buy levels are right here. So nothing really has changed long-term, but for the month, this is what it looks like. That looks pretty bad. I mean, it looks like it's going to continue downward. The COVID highs are here. And actually, if you look at the underlying stocks, some of the underlying stocks like growth stocks, a lot of them rebounded at their pre-COVID highs. What's some examples? Hold on, let me see. Oh, right here. See, initially, like here at this point, now Apple's revisiting its pre-COVID highs, but on its first touch, it actually bounced from it. Okay, if we look at a lot of stocks, it's like that. A lot of stocks jumped. Oh, this one hasn't come down yet enough. Pre-COVID highs. This one hasn't come down to pre-COVID highs yet. I can't remember off the top of my head here. Oh, here, Amazon also did. Amazon hit its pre-COVID high and then bounced right off of it. Let me show you on the daily. Yeah. So it touched its pre-COVID high and then bounced. Same thing with Apple. A lot of tech stocks did that. I'm not sure if QQQ, did QQQ do that? No, it hasn't done it yet. But anyway, so I noticed that a lot of the stocks did that. So that's maybe something that we should think about too. What if the S&P 500 futures does that as well? And if you look at options positioning, there is a lot of positioning here for 3,600. 3,600 actually, it's one of those put levels that I talked about. Remember, we talked about it in Bitcoin, that we talked about it earlier today. Here. We talked about it earlier today. It was approaching 20,000 and we had a put wall there, and implied volatility went up, and put buying, everybody was trying to, people who were short their puts, so usually like market makers and institutions, they had to hedge their gamma and their delta exposure, and boom, there it went. Because as implied volatility went up and put orders still kept coming in, they have to hedge for all of that, because now gamma's working against them on such short expiration. So it was a big expiration week this week. All right, that's why this happened. Okay, it can either cause a panic or a squeeze, and right now, and that was a huge. These work as pivots, these put walls. Okay, so same thing with S&P 500. If you look at the options chain for SPX. There is a huge put wall at 3,600. Okay, huge for most expirations. All right, so there I can see being like one of those make or break panic moments. And in the equities, what tends to happen in those moments is that we'll see like a weekly candle that has this huge tail at the bottom. All right. Initially. So it will touch there and maybe it will panic a little bit. So then it will probably have like a wick down, and then it'll close a little bit higher, like in the middle to upper range of that wick or of that candle. So we see that a lot when there's big put walls and there's panic. Like it happened. Well, these are not good examples, but you see that right here, right there. There was a put wall right here, and they panicked. Okay. Because IV kept going up, VIX kept going up, and all those institutions and market makers that were short puts had to hedge, and there was a dash for those puts. Same thing happened here. It blasted through those put walls and panic. There was panic. It happens over right here. This way, it happened here too. This was also. Look at all the dates of these. It just so happens to be always like a week or two before OpX, right? It tends to be that. All right. So these again, you don't have to trade options to care about options, but it does. It even affects how the chart looks. All right. This is a good, I think, point. If we see 36 right here, okay, if we see the market come down here and we see that big wick, and then we see the VIX actually falling afterwards, and then the market recovering for that week, I think that would be a bottoming signal. Generally, when that happens, the market tends to rally a little bit longer after that. The rallies tend to be a little bit longer after an event like that. See this as continuation. All right. You usually see some type of continuation after something like that. We haven't really seen anything like that. I mean, I think we saw actually. No, that wasn't it. Those weren't it. No, these are all after those monthly OpXs. Okay, so these are more like probably more like daily moves. Let me see. Yeah, they were more like daily moves, short covering. But again, it works on that premise where there is like a mini panic that happens because all the short puts, some institutions have to cover. Okay, I'll actually look at these two. I may be wrong about this. This may have been a similar situation, maybe on the weeklies. Maybe there was a big weekly wall or something. All right, but that's where these come from in the indices usually. Okay, and we see it in like big OpX months. I know this was a big OpX month right here. This was big because that was the first or second major sell-off after COVID. So that was a huge OpX. And that's a quarterly too. That's a September quarterly. Those tend to be big. End of year, that December 2018 where we blasted through that put wall. And then here, again, some of the puts were short. And then we had that big wick down and then people covered. People sold off those puts. They cashed in their hedges, and then we saw continuation. So if we see something like that, I suspect that kind of pivot exists right now in the market for the S&P 500 at around 3,600. All right, 3,600. So if we see that big kind of wick and then it comes back, I think that would mark kind of a bottom. Okay, the next one. All right, and September is a huge OpEx month, and so is December. Those 2 months are huge right now. If you go to S&P 500, actually, let's look at it together. All right. Somebody's mic is hot. Whose mic is that? Okay. He'll be fine. Okay. September. Let's take a look. Oh, it's because it's September is 3,600 right here. Yeah, 28,000. That's a huge OpEx. And then 28,000 is there, but then also too, I think the months prior, we also have a lot at 36,000 as well too in August. Let's see. 3,600, 16,000 at 36. And then I think also for July, we have that too. And July expiration is 2 weeks away. So I'm sure in the next 2 weeks, they're going to roll into a lot of these further dated options from this month. If I remember correctly, I think this is a pretty big month too. And I think a lot of that is at 3,600 as well. Yeah, 26,000. So actually we got some closer to at the money's 28,000 here. So yeah, I suspect, and then if let's just one more. Let's look at December. Uh, 3,600. Yeah, that's a huge month again. 3,700 too. 3,700 actually looks like it's big too. Maybe it's changed. I know that with options too, everything changes. It can change week to week what the strikes are. Because people continuously hedge and they roll. So I'll take a look. But also 3,700 looks like a pivot point just from just a quick glance when I saw it. So if we were to expect something, I think that would be a good point. One thing I noticed was last month like that. I'll check. Let me check to see what last month's was. Oh, by the way, last month's low happened to be 16 times forward earnings, like to the dot. Like I mean, it was like I think literally 1 point away from 16 times the agreed upon by most of Wall Street analysts forward earnings on the S&P 500. So literally the market came down to that point, 16x right here. So obviously there was some value hunting going on. Now it's a matter of, do institutions believe interest rates will go up or not? Okay. And so let's look at monthly charts again, because this is the end of the month. Let's see here. Hold on. Nunya, I'm gonna mute you just for a second. All right. Because your mic is on. Okay. Thank you. All right. Okay, so here is TNX for the month. Okay. And I think this may be the top for this season. That doesn't mean it can't go lower. So that doesn't mean S&P 500 can't go lower. If the market turns out that they feel like they're wrong about interest rate expectations, then we can definitely see it come back down. And I think at 14x earnings, I think it's at that 3,200 zone. I'll recalculate. I'll get the files out later on. I'll share that with you guys next week. But yeah, it's around that 3,200 zone. I think that was the 14x. Also depends on what you assume for earnings. Like, I have a model where it's absolutely no earnings growth. So I just use like the trailing 12 months. That tends to be a little bit more like bearish for the bottom levels. But if you want to use what Wall Street uses, which is the estimated forward earnings, this was the value level right there on SPX, that 3640 or so. Wherever that bottom is, it was literally within 1 point of that. So definitely, I think there are institutions looking at this, and they're definitely buying on valuations. But that valuation is dependent on this 10-year treasury. So you have to watch this like a hawk. If you're a bottom hunter right now in equities, you have to watch this chart like a hawk, TNX, okay? On the big board in the New York Stock Exchange, they don't quote a lot of bonds. There's one bond quote, and that's TNX, okay? There's one. That's this. It's right in the middle because it's super important, all right? If you ever get to see it, you'll see it right in the middle of the board, okay? And that looks like it's breaking down. This, I don't know how much weight to put on the TNX chart. However, the TIP TLT chart is a tradable chart. There actually are people who trade this. They'll long the TIP, short the TLT, or they'll long the TLT, short TIP. This ratio trade is actually quite common amongst institutions. It's actually very capital intensive. It takes a lot of capital to do this trade. So you don't hear about it a lot in retail, but institutions definitely play this, okay? And it's actually not that uncommon. Big institutions do it. But this definitely looks like it's breaking down. This is the end of week chart. This is the end of month candle. So, if people went long and then right here, and the thing that really scares me is like, what if people who went long this ratio, well, not scared, but what kind of has me like worried about a big change coming in the market right now is that what if there was a lot of people who went long on the TIP TLT trade, many institutions, what if they went long at the lows last month, expecting this to go up, expecting inflation expectations to go up? Because remember, we had those really bad inflation readings, remember? Even the White House, even the president came out and said, hey, or the White House representative, whoever it is, they came out and said, hey, this number might be, worse than expected. Brace yourselves, right? And so, I can see, and then the reading did come out pretty bad. And so I can see a lot of institutions going long on this, going long TIP, short TLT, thinking it's going to go up. Well, it did go up, but now we're under that. All right. So are there a lot of bulls that are trapped here? A lot of people that went long that are trapped? Very well could be. So this unwind, may take some time. Look at all these people that went long all these months, right? All these longs here. And then 1 month, it could be like a couple months of this coming down. And if that's the case, I can definitely see this rally having some legs. Maybe this is just a retrace, right? Maybe this is just... on the monthly, it doesn't look like a retrace, right? On the monthly, it looks like it's really breaking down. On the weekly, though, maybe this is just a retrace. Maybe tomorrow, because the weeklies don't close until tomorrow. So if this closes like a little bit higher for the month, and then we see like implied volatility coming down because people are selling their puts, then maybe we see some type of like continuation and then back up. That's a possibility. I'm not trying to predict the future. I'm just trying to look at some possibilities here. I think that's a possibility worth thinking about. Okay, maybe this was the bottom, because when it comes to valuation, this is 16 times forward earnings. Okay, we would be like at average or below valuation right there at that point. So we saw a lot of institutions coming in. Also, too, remember that ratio I told you about, the IVW-IVE ratio? If this goes up, if this is trending up, it means that growth is being favored over value. If it's coming down, it means value is being favored over growth. All right? So it's who's going to outperform. Is the NASDAQ going to outperform or the Dow? The NASDAQ usually outperforms when this is going up. The Dow outperforms when it's going down. Okay. Back in November, December, or right here, back around January, I told everybody, I think the Dow is going to outperform the NASDAQ this year. And where I got that from was this chart. I just saw this. I just saw it making lower highs, lower lows. I said, maybe it trends down. And if it does, Dow's going to outperform. So that's what happened. All right. This might go up on the monthly. I mean, on the monthly, it looks like couldn't recover. On the weekly, however, oh man, on the weekly, I mean, it looks like growth took a hit. I mean, the NASDAQ, took a huge hit. HYG for the month. This is also something that I want to look at. HYG. So HYG is junk bonds. Okay. Now junk bonds. What happened today? Did it go up today? Trading View. No, it's closed a little bit down today. It just has a hard time going up, and you really want this to go up. You want the junk part of fixed income to be doing well, and that usually means liquidity is entering the market again. All right. Let's actually see if this is updated today too. Advances and declines. Let's take a look. Come on, FINRA. This is just laziness, because bond markets close earlier than stock markets do. They had already some time to do this, and it's not like this is some interactive chart. This is just some numbers. They just got to. Oh well, okay. It is what it is. It is what it is. We'll wait a little bit. Okay, we'll wait a bit. But that is going to be really telling. I want to see. So if we see, okay, so remember that the phenomenon I was talking about? It happened in Bitcoin where we saw that panic. Okay, so the other side to that is, and usually right after a panic, this is actually what happens too. But sometimes, and usually most of the time, there is no panic like that. Usually it's just a straight V. At least in the last 10 years, it has been like that. Let's see, like. Not that, but some of the other ones, some of the more shallow ones, like this straight V like this, usually sometimes there's no panic and it just all the puts get sold off. So which is a possibility, right? As it approaches, as I said, as it approaches a put wall, if the VIX is not rising, if implied volatility is not rising and those put order flows don't come in, that's where we see all those big V moves. Okay. Now, when those V moves fail is usually because when we approach those put walls, implied volatility goes up and those put orders still keep coming through. And when that happens, the market maker or anybody who short puts it dashes for more puts to hedge that delta and gamma exposure. So that's why sometimes you see these big wicks down, but then those people will cash out and then it will start a rally. Okay. So usually afterwards you see that kind of short covering that happens right afterwards. It doesn't have to run all the time, but again, whenever that implied volatility starts coming down and those put sell orders start coming through, that's where we get these huge short squeezes. But, for the month or for the week, if we see that type of like down, and I think that might happen around 3,700. Okay, so if we approach 3,700, and if there's like a big wick down, all right, and that wick goes all the way down to like the lows at 3,640 or so, and then let's say it closes above these lows, I think then this becomes the bottom. Okay, so if we have a little panic at 3,700, like a small little panic, because puts have to be bought because of delta hedging, because implied volatility keeps going up as it approaches 3,700, then I think, and then if it tails down, all right, if it tails down below these lows, but then recovers to close above these lows, that is a signal that this is the lows, at least for the year. Then we go up. Okay, so I'm revising my plan, and that is just, I think, just from the options itself. That's just from what I saw just now. Let's just make sure. I'll have to run some more numbers first, but just at a quick glance, I mean, yeah, 3,700. I mean, 3,700 looks like it's a huge OI as well, multiple months, right? It's even bigger than 36. Because last time I calculated this, it was before June OPEX was over. So a lot of new options could have rolled into this. Valuation lines, the old plan, the plan that we talked about still holds when it comes to valuations, when it comes to possibilities with interest rates. But maybe interest rates don't come down like that. It's about the same. Volume open. There's not that much here. There's not that much for October. Not that much hedging for October. Actually, you know what? For SPX, not just the monthlies, but also the quarterlies also have usually high OIs too. And high volume as well. Not as much. Oh, well, for 37, not as much. Okay, not as much. But then December, I remember from memory, that is just a whopper, right? Yep, it is. That's huge. Okay, so 36, 22, and 32. Yeah, it may have shifted. So, okay, so that, like, put wall where, there might be, like, a slight panic. I think the setup is actually, that might be 3,700 now for that options-based kind of movement. Okay, so here's the thing. Okay, so again, this is where like the plan. Okay, so maybe the plan is going to change just a little bit now. All right, so if like there's a lot of ifs to this. Okay, all of these things have to happen at once. Okay, if one of them doesn't happen, then this is not a good signal. Let me say that again. Everything I'm about to say right now, everything has to happen together at the same time. Okay. If it doesn't, even one of these things is not true, then this is not a good signal. Okay, but anyway, if we see for the week, either in the coming weeks, as it approaches 3,700, if we have a slight panic there, where as we approach 3,700, as we approach that put wall, we see VIX rising and the put order flow still coming in and people are still buying puts, we may rush down to new lows. In that same week, if we can recover above this week's close, if we recover that in that week, then I think this will mark the bottom for the year. Okay? I rarely call a bottom. I always say it's a range of possibilities, right? So, this is not something that I say lightly, okay? I rarely call for a bottom. But just from what I see right now, and I just noticed it now, and just with all the options activity that I'm seeing, I think it's a very likely chance that if we get to that 3,700 and we blast through and we recover in the same week, we just have a big tail down, a wick down, but we recover these lows in that same week, this will be the low, because this is 16 times forward earnings right here. This was exactly 16 times forward earnings, like to 1 point. That means institutions are buying at 16 times forward earnings. They're not waiting. They're buying here. They're not waiting for these lower levels. Okay? Because even though we use the same models, the modeling, the price, the fair price that it gives you is different based on different assumptions on earnings growth, different assumptions on what the future interest rate is going to be. But I think that will tell us, that price action I just described will tell us that most institutions are using assumptions of 16 times forward earnings and 3.5 top for 10-year yield. That means that's what most institutions are using as their valuation input. Okay? So I think that's pretty important if we see that. Okay? But all of that has to happen at once. It has to be like a clean, break below 3,700 as VIX is going up, puts being bought, and then we recover it all in the same week. And if that happens, that marks a low. Boom. That means there's enough. There's definitely then institutions are using these parameters. That will be the bottom, the seasonal bottom. 3 to 6 months we will rally probably after that. Okay. So that's the plan. Now, if one of those doesn't happen, let's say we lose 3,700 and just keeps going down and we recover a little bit, but we don't recover these lows. No, invalid. We could still. That means that the institutional buying here is not as strong of a hand as we expect. That means there's stronger hands are waiting lower. That's what it means. Okay. So if we bust down and we can't recover all the way, it means the stronger hands are waiting down here. That means we could be going down more. Okay. So all the things have to work. All right. Hope I was clear about that. Okay. So that is the reason why I like to look at things on a monthly basis like this. It gives us a bigger picture, and sometimes it allows us to see things that we didn't see before. So you just saw me do that live. All right. That was good. Okay. So monthly, that's what it looks like. Ooh, let's go back to our little bond thing. This would also help us confirm a bottom. If we have 4 or 5 days of advances over declines. No, that's still yesterday's. They still haven't updated that yet. Come on, guys. What gives? All right. We'll wait. Okay, so that is monthly. Let's take a look at some yields. This is the monthly yields. Let's see if it's inverting. Oh, oof. Well, that was not a good month. Okay. If it further inverts, that is a bad sign for bank stocks. Oh, well, this one, it recovered. Maybe it keeps going up. This, well, banks are a big sector. So the question is banks coming down, is that bad for the S&P? banks are a pretty decently sized sector, and if banks aren't doing well, if they're not lending, then that is you know less liquidity in the market, right? In most rallies that are sustainable, you want banks to rally with your tech stocks. Now, it doesn't have to be at the same time. Like, tech stocks could be strong for a couple of weeks. Maybe they consolidate, and while it consolidates, the banking stocks come up. I mean, it can be kind of like laddered like that. But generally, you want them going together. You want that breadth to be good. Speaking of breadth, hold on. There is a breadth study that you can actually look at. Hold on, let me see if I can get that for you guys. Is it this one? Yes, it is. Yes, it's this one. Okay, this one. Hold on. This one. Yep. This is the New York Stock Exchange new highs, new lows. So it looks at like, stocks that are making new highs versus new lows. If it's coming down, it means more stocks are making lows. And if it's going up, it means more stocks are making highs. Okay. And this is a cumulative chart. So it adds those numbers, more, so if there's more new lows and new highs, then it's going to be a negative number. So it's going to make your line keep going down. If there are more new highs than new lows, then it's a positive number. So it gets added on to this at the end of the day. And then if you have, successive positive days, then this line starts curving up. All right. So from what I've from my own studies, and this is something that I learned from somebody else, but I back tested this myself, and I took a look at this chart way back in all the other bear markets and bear market rallies. This chart needs to come up, and it needs to get over these moving averages in order for it not to be a bear market rally. In all previous bear markets, if this line didn't curve back up, it was always a bear market rally, and the market would go back down again. Every example, almost every one. I don't think there was a single one where I saw in the last 30 or 40 years. This has to curl up in order for it to have a sustainable rally, and we're back to bull markets. It's not a bull market until this goes back up. It's a bear market rally. All rallies are bear market rallies until this goes up. But this measures a little bit of breadth. So in order to get some more new highs, you can't just have all tech stocks making new highs and everything else just going lower. Because if that's the case, then this number and this is never going to curl up, because you're not going to have enough more new highs. You need more new highs in order to get this number to curl up. So that's why I bring this up. But this is also kind of useful too. The New York Stock Exchange, new highs, new lows, cumulative line. So I'm going to look at it. Most brokers have this. You can even get this on the Fred website, I think, St. Louis Federal Reserve. It's free, or you can get it on stock charts, or I don't know if TradingView has it, but there's you usually on any free service you should be able to get it. Okay, so anyway, that's something I learned back in the day. It still works actually. What is it? Here, it never curled up over the moving averages. The bear market rally, it never curled up. It never curled up here for the March bear market rally either. It never got up there. It flattened, but never curled up. So it went down. It never curled up. It went down. This now is starting to flatten, but it hasn't curled up over all its moving averages. The moving averages that I was taught was 29 and 4. All right. It needs to curl up above that. And then it needs to start going upward. All of these. So it should then be the line 4, 9, and 20. But that's not the case right now. Right now, the 20 is on top. It's the reverse order of what you need it to be. You need the cumulative line to be on top, then the 4 underneath, the 9 underneath, and the 20 underneath. And that's when it's a sustainable bull market again. We never got that. Not for May, not for March. That's why I was so confident that it was a bear market rally and this is not a new bull market. A lot of people on Twitter were saying, oh, it's a new bull market, new bull market. It's like, no, not until this curls up. And also other macro factors too, like inflation. I mean, there was still a lot of uncertainty about inflation and interest rates. And I know from just studying history that inflation is just not one of those problems that just goes away quickly. It's a multi-year problem. And oftentimes, if you look at long stretches of inflation, oftentimes people called the bottom way too early. People always said this is the new bull market. And yeah, I mean, it might be a mini one that lasts like a year or 2 years, but then it comes back down. Like in the 70s, actually, I look back, one of the bull markets actually was more than a year long. It was like 2 or 3 years long. So it happens. I mean, so we could have something like that here too. Okay. Again, like it's a realm of possibilities. Okay. There's no such thing as an absolute when you're trying to talk about like future events. Anybody that talks about future events like they're, certain, they're usually crazy or they're going to be dead wrong or they're managing risk very, very poorly usually. Those are, people who are trying to sprint in a marathon. They're not going to last. Okay. Do I think today's price action has to do with Powell's comments yesterday? I don't know. I don't know. I wasn't aware that he said anything too crazy. But I'll look into what he said yesterday. I don't see that. That's just purposely. There's a reason why I don't look at the media often during the trading week. I usually look at the news like on the weekends when the market is closed. That's usually when I look at like the news and what's happening. And the reason for that is because it gives me that mental clarity. I'm not telling myself a story. Okay. I'm just looking at data, just black and white. Sometimes it's our own humanity that gets in the way of making good decisions. And sometimes those stories get in the way. But I will look into it this weekend, though. He said the current market factors may have changed the way the world economy works forever. He said that the current market factors may have changed the way the world economy works forever. I mean, like Ukraine war, less globalization. Okay. The supply issues though, I mean, it's not going to be, that's, no, yeah. I mean, no, those may work themselves out in the future. I don't know. That is a huge question mark up in the air. Although, when it comes to the way the world economy works, I mean, yeah, it's always constantly changing. I mean, technology, right? I think anytime that we have technology differences, it changes the way the world economy works, right? Think about the internet. Think about computers, more computing power. So all of this changes the way the world economy works, right? So I don't know how much weight to put on those words. I think it's fear mongering. Yeah, maybe it is fear mongering. It could be. Maybe it's the Fed calls. Maybe he's trying to slap the market down because it's not coming down fast enough. Okay. Maybe he's trying to talk up the dollar because the dollar has been a little bit weak. Or maybe, he saw it coming down a little bit and he's like, oh, I don't want it to come down too much. It could be. Again, stories we tell ourselves, and I'll look into it this weekend. But, as far as the data is concerned, and probably, you know what, man? I wouldn't doubt that Powell is looking at the same data we're looking at. I wouldn't doubt that. This is clean data we look at. It's clean, it's good data. He's probably looking at this and thinking, what the hell? Like, why is the market expecting inflation to peak? Why are people selling out of their inflation protected puts and buying, long term? Maybe he sees all the consumer excesses still. Maybe he sees California giving cash to the people. They're still talking about in California giving cash to people. Like, we're gonna all this inflation because of us pumping money into the markets. we're gonna fight it by pumping some cash into the economy. I mean, I don't know. It's yeah. So that, you know, maybe that caused him to be like, hey, let's like temper this. You know. I mean, there's all types of signals right now. All types of signals. The 10-year, the 30 and 10-year. This, so, you know, a lot of people use the 10-year and 2-year difference as like the barometer for like the economy. This has a lot of false signals. You know what has less false signals? 30 and 10. All right. And the real pros who really know the bond market and who are looking for, you know, and this is still not 100%, by the way, but this is better. It's better. Okay. The real pros look at this. All right. And I'm sure that had him kind of worried. You know, didn't move much today. I mean, so yeah, it was already up for the last few days. When did he say this stuff? Yesterday or the day before? When did he say all this stuff? Yesterday. Okay. So yeah, I mean, yesterday it was at one. It was at, yeah, it was right here to here to here. So monthly. I mean, yeah. I mean, if it didn't pop up today, it would have closed here. I'm sure that's still probably, you know, he probably wants this to kind of keep going. Dollar. Futures. Oh, did they call it something different? Oh yeah. Okay. Yeah. So dollars too. I mean, last week he saw it fall. And, you know, a couple days ago, I don't know if he checks it on a daily basis, but, you know, I'm sure he knows that a day is not a trend. But, you know, we saw for most of the week, it was in the lows, you know, and a dollar loosening too quickly definitely would undermine all the work that the Fed has done already, you know. So I'm sure they don't want to get undermined by that. Also, too, last week, remember, we saw 2 days of advancing bonds. Thursday and Friday, we saw, remember? Guys, I'm telling you, dude, this is what the people, movers and shakers, this is what they're looking at. Okay, they're looking at the same things we're looking at. Okay, this is like good data. Okay, it's all free. It's all free. You know, you just gotta listen. You just gotta listen to the right thing. Anyway, so you know, last week we had 2 days of more advances than declines. Okay, and generally when you see like 3 or 4 of these in a row, it means liquidity is coming back into junk. It means that zombie companies can now borrow money again cheaply. So he doesn't want that. He doesn't want that. Okay, so I'm sure he saw 2 days like this in a row, and maybe he said, you know what, I need to smack this market back down, and maybe that's why he said that. Could be. Okay. Is this out yet? Dang. Come on, guys. Amateur hour. Somebody went to happy hour too soon. Yeah, somebody went to happy hour too soon in the East Coast. Okay, well, it is what it is. Once that comes out, I'll try to post it on Discord. But that's the monthlies, okay? So the monthlies, that is our expectation. Again, that formation that I talked about. If we see on the weekly chart that 3,700 getting tested, we see VIX going up and put orders coming through, lots of put buying, and it blasts through the lows, and then it recovers that same week above this level. All right. Above that level, if we get, test 3,700, VIX keeps going up, put buying still happening. Boom, we have a little mini panic. You know, maybe not that much, maybe not that far, but maybe it comes here and it goes like to 3,600 or so. And then if it recovers above this, that will be the lows. That will be the low. Then we're going to rally again. That means that institutions, the strong hands, are using the same models we're using, but they're using the inputs as 16 times forward earnings. That's what it means. That means all the strong hands are using that input on our modelings. So our model is different based on you know, our interest rate expectations, you know, DJT, I'm sure you can comment on this too. It really depends on what your inputs are. That shows you what your levels are. And this was just us being more conservative about future earnings and also more more bullish on the yield. So, you know, this is assuming that earnings growth is not going to be as good. You know, you're looking more like trailing 12 or, you know, no growth at all in future earnings and a much higher interest rate. So that's these levels, okay? But that may not be how other institutions are using that model. I think, you know, this right here is that 16x forward earnings. And again, if we can see that, it goes below there and it recovers all of that really quickly, then that means all the strong hands are using that same modeling, same input. Okay, that would be a huge confirmation for us. And that is when, you know what, I would go long if I saw that. I'd go long aggressively. I would actually just buy my SPY shares right then and there and start buying calls right there, if that happens. But all of that has to happen in the same week. All right, all of that has to happen in the same week. Everything I just said, even if one piece of that is not there, no, it invalidates it. Okay, just remember that. Okay, I think I've repeated that at least 5 times. I do that on purpose. I'm a teacher as well. I teach, you know, for private. I have my own, you know, teaching operation, and I always notice that it takes about 5 to 7 times. You know, it's certain concepts, like if it's a little bit difficult, I find that repeating it 5 to 7 times makes a difference. I don't know. If it doesn't, I'll stop repeating myself. But anyway, that is what I see. Okay. Let's look at some monthly charts of everything else we're looking at. Oil, damn, come on. Next month, give us this. Please give us this. That would be such a good short. Oh my God. It'd be amazing. Amazing. Ooh. That's ZC just rolling basis. What about just like this? Okay. A little bit better. Not by much, but okay. So yeah, that's not enough history though. That's not enough history. We'll just use this. I mean, it'd be nice. It'd be nice if we can get back. It kind of looks like it wants to do that though, right? If it follows the trend, if it follows that trend, I don't know if that trend will be followed. This actually is anchored to some key points in volume. Does it happen to be repeating? No. Screw that. No. Okay. Well, that happens to be the trend. Are trend followers going to buy, and speculators, are they going to push it back up again? I don't know. I don't know. I'm not going to hold my breath, though. If it happens, it happens. I got my alerts. I have my alert. If it alerts me, boom, I enter the trade. I'll let you guys know. Okay? So that's that. HYG. I just can't stress this enough. HYG, though, long term, it's kind of not very good to chart just because of the monthly dividends, and also it's got a pretty high ETF fee. So it's not the best thing to chart long term because of all those dividends and such. TLT. Could this be a seasonal bottom for TLT? It could be. Maybe it goes back up a little bit and then back down maybe a year or two later. It could. Bigger trends. As you can see, sometimes it takes a while to break a trend in bonds. Bonds are huge markets, way bigger than stock markets. So, you know, it's a lot easier to turn around a tugboat than it is a Titanic. I mean, that kind of looks like it's breaking out. You see on the monthly chart, the dollar looks like it broke out, retesting these highs and then bouncing from it. Does it not? Doesn't it kind of look like that? I mean, it does to me. So we'll see. We'll see what it does. monthly chart, this to me, that looks like it's going to continue. Just keep, trend is your friend, right? But we'll see. We'll see. So yeah, that's the month in review. Oh, wait, something's happening in Bitcoin. Whoa, 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 whoa. I'm getting alerts on my phone. I'm getting mad alerts on my phone for Bitcoin. What's going on with Bitcoin? Uh-oh, let's take a look. Let's take a look. Let's take a look. Bitcoin. Wow, my phone is just going crazy. Bitcoin. Oh, you guys are saying Bitcoin to me too on the voice chat text. I didn't even see that. My phone just like started going crazy. Where is this all-time history index? There we go. This is what the monthly looks like. Looks like shit. I mean, the daily, oh, it's breaking down. It is breaking down. Okay, let's take a look at what's going on here. Where's the okay. No volume. I need volume. I need that to go away. And I need to maximize the screen. Okay, let's do this. I don't know what that is. Positions, I don't need that. Okay, so puts. Orders are coming through. Or are they? Let's take a look. This is for 11 hours. When did this start? $434. Okay. Oh, wow. All this put buying. Look at that. Look at that. So put buying, it was all a lot of September's and July weeklies. So July weekly, July 1st, July 8th, and it's September 30th. Some July 22nd. But it's mostly July 1st, July 8th, July 2nd. It's a closer dated. Closer dated July and September's. Closer dated July's and September's. July. There are some being sold, but it's like in the money. So some in the monies are getting sold. So this is what it looks like, okay? So it looks like, those puts that are being sold are in the money. So it probably is like a long-term hedger who's now cashing in on these longer dated puts. They're cashing in and there's hedging for short-term, okay? Shorter term hedging. So like July and September hedging, but they're cashing in their Decembers that are in the money. Okay, so they're probably using some of that premium, probably saving some of that premium in cash, using some of that premium to hedge more shorter dated because they see some shorter dated risks. All right, DVOL is up. DVOL is up. So that goes with my theory there. It was July 1st. There was some July 1st and July 2nd. Most likely around here. So they're definitely buying. So they're buying here. So as there's buying in this, as there's hedging demand, it's pushing down the price as market makers are coming in to take on that order flow. They have to short the underlying, but then the market makers who are already short these high OIs that are in the money, the deltas, the gammas. Did I include gamma in all this? The gamma is now working against them, and it's probably pushing up their gamma risk, and so that means additional puts need to be bought. So it becomes like circular, okay? And that's why we have these little these big drawdowns, these panics can happen on these put walls because of that. Because the market makers who were originally selling those puts, now they have to hedge for their gamma risk. And if there's more order flow and puts coming in, so not only do they have to buy, not only do they have to short the underlying for those new orders, they have to then buy more puts to counteract some of those gamma that's working against them. And so that causes even more selling of the underlying. So as you can see, this is how order flow can really affect that and cause those huge wicks down. It's leveled off now. So we'll see. We'll see what happens. So it went from one put wall to closer to another put wall. See, yeah, it stops at 18,600 because that is the next strike down around 18,500. And we've got still some significant OI, and this is still for 11 hours away. That's a good amount of volume for 11 hours of hedging. That's a good amount of volume right there, all right? And that was for July 1st. July 2nd, not as much. So a lot of this is actually short-term. So a lot of this is short-term. So what does that mean? This is short-term gamma hedging. This is institutional. It's all institutional. It's all predicted by the same methods that we use for SPY. It's all short-term hedging, okay? All short-term, all right? You know what would be crazy? You know what would be crazy? I'm not trying to predict the future, guys. I'm not trying to predict. But what would be crazy is if by the end of the day, it closes around 20,000 again. That would be crazy. All right. All those puts then have to be rewound. So the hedgers or the market makers, they feared their gamma risk. And so they bought all these puts, and maybe after they're able to take some of that risk off the table and redo their books, maybe they cash out of certain hedges that they put on in addition to the order flow. So if that were the case, then yeah, I could see this coming back up to 20,000. But if order flow just keeps coming in with more puts, I mean, yeah, then it can keep going down. So we'll see. I mean, so if you're day trading this, definitely, I think you should keep an eye on that order flow, and just make sure, and keep an eye on this number. And you need, if you're long, okay, for a day trade, you want this to go down, and you want some of this to stop, and you want actually some of the puts to start getting sold. You want some selling orders to come through. Look at that. People are now going down the options chain. They're going down to 17 to 12. So it looks like, I mean, from just here, I mean, and this by no means, I mean, that's a decent volume, but not by no means is that a whole order flow. This is just in the last 7, 8 minutes. But it looks like there's some puts being bought, even lower strikes now on July 8th and 15th and 2nd. Okay. So yeah, I mean, people are going down. So there is a risk of continued selling, or at least the market is hedging for it. Oh yeah, look at that. Lower strikes. 13,000 for next week. 13,000. Wow. Somebody's hedging for that risk. A lot of people hedging for that risk. 13,000. So let's see if that hedging demand continues. Let's see if it continues. I have a feeling that it might. But again, you never know. I don't know. I can't tell the future. All I can tell you, though, is that if you're day trading, keep an eye on that devol. Make sure that number is going down if you're long, and make sure you start seeing red sell orders. Okay? If not, this is still going to keep going down. All right? And same thing, if you're long and you keep seeing all these greens coming through, all right, and you're seeing this number devol going up, maybe you should sit this one out because it might be going down. The hedging demand might be forcing it down some more. Obviously, there's enough of a risk and uncertainty out there in the market where the market feels as if they need to hedge for 13,000 for next week. Okay, there's enough uncertainty. That's what this means. What this means is what does the market believe? It's not about what we believe. That's not important. What you believe, what I believe, none of this is important. It's what the market believes. Okay, and the market is telling us there is a demand for hedging at 13,000 for next week. Okay, so they might be wrong, but the demand for hedging is there. Okay, it's there. It's worth enough to pay for that premium. All right. So I guess we can end with Bitcoin, unless you guys have more questions or more things you guys want to look at. Is there anything else you guys want to look at? Okay. Well, in that case, I'm going to sign off on YouTube. I'm going to keep the Twitch on as always. I hope that I can be available tomorrow. Tomorrow being Friday, July 1st. I am going to try to make some time so that I can be with you guys beforehand, but I don't know if I'll have the time or not. But if I don't have any time, just remember, I just want to remind everybody out there, we do have some, we got some friends here who are not Americans, who don't live in the States. July 4th holiday does fall this year on a Monday. So on Monday, markets will be closed for all of those celebrating the independence of our nation. I hope you guys have a safe July 4th out there. Make sure you guys get out on the barbecues. All right. Maybe we can have a little friendly competition to see whose barbecue looks better. Maybe, right? Okay. So enjoy yourselves. Don't get food poisoning. Don't burn yourselves with fireworks. Be safe. And most importantly, have fun, okay? Over the weekend, shut your computers off. No charts, no nothing, okay? We get back to business on Tuesday, though, okay? All in on business on Tuesday, but enjoy yourselves. Enjoy the outside. Touch some grass. Look at some fireworks. Have a good barbecue. And have a beer